this P&L or profit loss shows the price along here, higher price to lower price, and your profit or loss up here. So obviously, when the market goes up and the red line represents the Dow Jones Industrial Average, the structure is how you can bend and you could cut off the risk. And as the market goes higher, you can see that the Dow gains more profit. As the market goes lower, you can see the Dow loses money. With this structure, it shows when the market goes lower, the investor does not lose any money, and when the market goes higher, the investor participates. And based on the income from the bond, the participation rate in this case is 88.2%. This particular client invested $89,552, but he only bought 88 bonds. And when he bought 88 bonds, it cost him $84,450 because these are zero coupon bonds. There's no coupon, so you're buying the bonds at a discount from its par value. So today, you're going to put $84,450 in a bond that matures in 0.78 years, or in December 31st of 2024. In December 31st of 2024, the account is guaranteed to be worth $88,000, but you're only investing $84,450. You are buying, in this particular case, a call with a strike of $395. You're buying two of them, and the calls are going to mature on 12/31/2024, and that's the last day of the year, and it's a quarterly expiry option. The option we're buying in this case is a bit out of the money. The market today is 390.9, and you're buying at 395, so you're buying it out of the money. I have 89,552 to invest, but I only invest 88,000, leaving some money in the money market. So let's take a look over here where I'm actually spending 84,450, which matches how much I'm spending. I'm investing $4,290,000 in options. So if I look at the 84,000 plus the options, my total spend is 88,740. But I only have $88,000 invested in bonds. So actually, I'm eating a little bit into the overage, which happens to be $812, which means I'm actually spending more money on options than I'm getting the interest from the bonds. Because remember, the interest from the bonds is the difference between what I'm investing, which is 84,440, and what it's going to mature at. And that overspend is going to give me a negative carry cost of 0.83%, which means that the most I can lose if the market drops, if the market's down 40, you would be down negative 0.83%. If the market was up 40, you would capture 33.2% or 83% participation. And that's because, why aren't you 88.2? Because you're buying slightly out of the money on the option. So in this particular case, you are holding a negative carry, but you're also getting 88.2% of the upside. So in the next 0.78 years, if the market should have a nice correction, you lose nothing and then have the ability to rebuy the market with essentially all your capital back. The market should rally and it should go higher. Then you'll capture that gain, lock in that gain, and restrike a structure note for the next 6 months, 1 year, 1.5 years, whatever your time frame might be. So this is a fully protected note with a slight negative carry, and it has an 88.2% upside participation. Why would you invest in the Dow Jones Industrial Index, taking 100% of the upside with 100% of the downside, when you can capture 88.2% of the upside and none of the downside, except for a small negative carry.